Good afternoon, everybody. My name is Michael Grove. I am the Managing Director, Europe, Middle East and Africa at Hotstats. Hotstats is a global data provider collecting profit and loss data from hotels all around the world and returning that in the way of operational benchmarking and market insights to the industry. Now, our relationship with luxury hotels goes back some time. With regards to profit and loss benchmarking in particular, luxury hotels have much need and requirement for overseeing the holistic approach to hotel performance, not just looking at the top line, but also looking at the very dynamic business model that luxury hotels generally operate. And that's enough about Hotstats. My mission today is to provide you with a global performance update on profitability. And of course, in the current time, that is not as positive as I would like it to be. And I would like to provide you some insight both on the positive and the negatives as what is emerging from the profit and loss account in the current environment. Now, a bit of housekeeping. Our numbers include hotels, whether they are opened or closed, unless we are not receiving data for those hotels. So it's a very much a consistent sample during the process because we are collecting expense data even when hotels are closed. All figures are in US dollars unless we otherwise state. And luxury data is based on luxury hotels only, so that we can really focus in and home in on the profit and loss makeup that is emerging of luxury hotels. And I will share the slides following the presentation. So to begin with, well, of course, from a global point of view, hotels, there's no doubt at all, have suffered more than many other industries during this time. And that's both from a top line and a bottom line point of view. From a top line point of view, luxury hotels in particular, when you look at hotel performance, are really taken the biggest dive as they started from a higher base. The luxury hotels during the last 6 months have dropped sub $50 of TrevPAR, and of course in that circumstance with such a high cost base, it really can damage the profitability to the bottom line. When you look at it across the globe, actually most regions are suffering in a similar way from a luxury hotels point of view, as the virus has very much hit different regions at different times, but the recovery stage that we're currently in is still lagging very much behind last year from a profit point of view. When you look at it from an asset class point of view, actually there are many different angles to this. It does depend on region very much, so we have seen very different performance levels from region to region, whether you're looking at Europe or Asia Pacific. But I think the key really in understanding how this is materialized comes when you look at the last few months and how returning to profit has been the real focus. It's not necessarily the variance versus last year or the previous years. This has been very much about when we return to profit. And from luxury hotels perspective in particular, we've spent quite a few months below zero. And of course, as that is returning back to profit, we're now talking about how those hotels are going to emerge in a more profitable manner as the revenue then starts to ramp up. Now, select service hotels, full service hotels, they generally saw a few months sub-zero. Luxury hotels very much dropping down, and in certain circumstances down to over 120% year on year. This has been very much dramatic in the fact that the cost base is very much larger in luxury hotels, and I think that share has therefore caused that drop to the bottom line, and also the reliance on ancillary revenue. So even as RevPAR is ramping, we're actually seeing the effect of the other areas of the business, as I will go through in a moment. Now, as things stand, as you look at the global hotel situation, you can actually see from a profit point of view, hotels have generally around the world starting to return to profit when they are open. Now, the difficulty is in Europe in particular, the ramp up of revenue performance has actually been lagging behind the rest of the world. The US hotels generally year to date have been profitable, but of course, as you look on a month by month basis, there were multiple months where there was a serious hit to the bottom line. Most of that, or a lot of that, comes from the lack of government subsidies from a payroll point of view. And in Europe in particular, we should have seen some advantage in Europe due to the size of the furlough initiatives in the key countries across Europe. Now, why this comes into play in the biggest way for luxury hotels? Well, the revenue mix generally in luxury hotels is made up very differently to the other asset classes. over 50%, just over 50% of the TrevPAR is made up of rooms revenue, and the rest of the P&L, of course, around 25% of it is coming from F&B. Now, as F&B has been hit both by the social distancing guidelines, but also at government mandated level, where some of these outlets were forced to close during the months as we were starting to prepare for reopening with new COVID measures, that has, of course, hit the luxury hotels probably more than many of the other asset classes, both in a positive and a negative way, and I'll go through that in a moment. The segmentation makeup is, of course, a big part of that. Leisure guests very much driving the segmentation, and actually for the conferencing and the areas of the business that have since lagged quite far behind, they were actually not that large a makeup of the segmentation prior to the crisis. Tours and groups, for instance, a huge section of the business that's been left behind, is not necessarily a key segment of luxury hotels. The business guests, however, and the conference, the corporate travelers, they are very much big spenders in the food and beverage operation and the ancillary revenues of the hotels, and therefore currently those areas of the business are slightly lagging behind from a mixed point of view. Now, when you look at the key area of F&B, as I stated just now, 25% of the TrevPAR performance comes through F&B. Actually, there have been some positives come out the other side of this. We actually predicted during the early stages of the crisis that we would be looking at around about 69% of the F&B revenue on a per occupied room basis would be lost. And that has actually materialized slightly differently, because what you don't consider as part of this is that luxury hotels in particular are more of a destination. When guests generally stay at luxury hotels, those guests generally would eat at the hotel, and much of that hasn't changed actually right now. The distance in between tables and the fine dining areas in particular are the areas that are least impacted because of the distance generally between the tables. If you thought of, for instance, of the operations within the lower scales of full service hotels, you'd actually see much larger hits, because the area that's probably hit the most is the all day dining. Now, actually, what we've seen around Europe actually, in particular, is that the outlets in the vicinity being closed has actually driven footfall into the hotels, because the guests who would have gone out and would have done things outside of the hotel actually maybe have chosen to stay at the hotel. So we measure on a per occupied room basis. Admittedly, a lot of business would be driven from guests who are not staying at the hotel. But the big areas that we're expecting that we will see the impact of social distancing will be when occupancy levels reach a certain level. That means that the 69% that we had calculated prior to the crisis that would be lost through distancing, and also in the bar areas where there's possibly a bit more impact of the social distancing, conference and events. Again, once that fully reopens, you can expect to see quite a large impact on that area. From another positive point of view, however, we have seen room service revenues rocket. In the Middle East, for instance, we were looking at over 80% increase across the board. Luxury hotels, you see again around the world, we have seen quite large changes to the room service makeup, and again, an area that possibly shouldn't have been so impacted by the virus. In fact, you should in fact be seeing guests kind of pushing their service to the rooms rather than go into the restaurants. And it's all about how we're able to react to that and serve that in a way that really can be optimized and to our advantage. From I guess the positive story of this whole crisis has been the way that hoteliers have generally been able to curb costs, and the change to the cost base has been for various different initiatives. When I do these presentations in the UK, for instance, it's very much driven by the impact of the furlough initiative, and across Europe, again, very, very similar, where government support has really subsidized the payroll costs of the hotel, but also the added cost, the reduction of costs from suppliers and contractors who have also received this payroll subsidy and have therefore been able to pass that saving on to the hotels. So really that has been driven, that is in the numbers, and it really clouds the picture as we emerge from the other side of this, but really does help the performance of both open and closed hotels across Europe. Of course, when you look into the Middle East, and we talk about most parts of Asia Pacific, certainly the US, that has not been very so much to their advantage. And therefore, the picture is a little bit clearer because we've been able to see the actual savings to the bottom line. The temporary cuts have not been necessarily been so obvious. So we've been able to actually to evaluate that coming out the other side of it. The good thing is, and I guess the positive, if you're looking in normal time, you'd probably anticipate around about 40 to 50% flex. And of course, with the size of the revenue drops for luxury hotels, I think achieving 40% flex at this time has been very much a success of the situation, as I am maybe clutching at straws trying to find positives of the environment. Now, one thing that we should always keep in mind, and that is why I stay very careful when I talk about cost reductions, and again, talking back to the furlough situation, is the fact that we need to find trends in the changes into the P&L. Right now, what I'm presenting to you is the current makeup of the P&L, and we all understand that that will evolve and change over time. But the big thing that I guess the hot topic as we came out the other side of March and April was, what would that mean from a COVID process point of view in the hotels? Are you spending more servicing the guests in the hotels due to the new COVID measures? And actually, from an expense point of view, we saw it rocket. We saw some areas go up 66% on a per occupied room basis. And that really was quite worrying because, again, the cost makeup increases and the revenues have fallen through the floor. It really can be quite worrying for us. But I always said we should continue to monitor it over a period of time. And actually, that period of time, if we took the 6 months that we've now been assessing since, we saw a huge surge in on a per occupied room basis, and it's now plateaued back down to the prior year levels. And that really does kind of give us some hope that those costs that were going into the business possibly have now normalized, and hoteliers have learned how to deal with that as things are coming up the other side. It could also be the fact, of course, if you measure on a per occupied room basis, there is the risk that some of that was related to the fact we were cleaning rooms that were not occupied. Of course, we need to consider all factors in this conversation. But I think we can take some kind of sense out of the fact that on the other side of this, we are normalizing back to the prior levels, as did China 2 months back. So the question is, has the P&L changed for good? Do we have enough data right now to understand how payroll has evolved, what that means to the expense lines? Now, from a payroll point of view, we've seen quite large drops from on year-on-year basis. If you take where we were last year for the month of October, and then we assess that against April, which for most countries was the lowest point during this crisis, huge cuts to payroll across the board. And of course, that indicates many different things. We've already spoken about the initiatives, but also, of course, impact to both employees, to owners, and again to taxpayers. So I think what we really need to understand is that how things have emerged in Asia Pacific is possibly a good indicator for how hotels will emerge across the world. In China, in particular, we saw 2.5 percentage points drop in labor costs. When you look at the payroll margins, so 2.5 percentage points drop, and that changed. That then the knock-on effect of that was a 2% increase in profit. When you look at the wider Asia Pacific region, it is slightly different. But what we're now measuring is how that evolves from the lowest point in April back to the prior year levels of TrevPAR, and what that then, or pre-crisis levels of TrevPAR, and what will happen for from a per available room basis from a payment point of view. Now, the other part that's, I think, over the years we've pretty much considered that the variable costs will be variable. We will always match them up against the revenue changes and the segmentation changes. But actually, the other part to consider is the undistributed costs, because these were the areas that really, prior to the crisis, you couldn't just take a blank slate and cut costs out of the business. Both a mix of the ability of suppliers and contractors to be able to work with the industry and help to reduce some of these areas, and also, of course, the fact that hotels were considered not just temporarily closed, but also really in many circumstances choosing whether they would be permanently closed. And those situations meant that the costs were totally relooked at. A pure white paper review and a zero-based budget of the cost lines has meant that when you're reviewing the P&L right now, you're really going through and scrutinizing those fixed costs, and that's really materialized through the P&L. Sales and marketing really feeling the largest hit. Much of that, we should say, is linked to the marketing costs of the branded hotels, but also the fact that right now as hoteliers are needing to pull back costs from the business that don't directly relate to serving guests, there is unfortunately the fact that much of the spend has been put on hold. How much of that will return to the P&L again is yet to be seen. What we can see is that as things are ramping up, luxury hotels again in particular will have the highest way to go. They need the furthest way to go to get back to normalized levels, and therefore we'll probably see a large amount of the costs coming back into the P&L in order to market it and to serve the guests coming back into the building. Now, this can actually be measured in two different ways. And of course, we've looked at it from an asset type point of view. We've looked at it from a regional point of view. The real beauty is when you're able to look at the situation between hotels that are open and closed, because that's a key decision right now for hoteliers. And I think that the only way to really review that is to understand what is your break-even point and how long will it take you to get there. I think for luxury hotels in general, I will go on to break-even in a moment, but if you look at the split between open and closed hotels, there is quite a difference between the levels of payroll and expenses that serve in the hotels. The fact is that from a TrevPAR point of view, there is still some ancillary revenue in closed hotels, but that the costs of the payroll and expenses are not directly linked to it. When you look at the open hotel scenario, you can really see quite a large difference in expenses. And of course, as you decide to open those doors, you really have a lot of the costs that are not directly related to serving this individual actually creeping back into the business. And I think that is the point, is that while the hotel is closed, you can pretty much put a blanket cost-cutting exercise across the building. From a break-even point of view, prior to the crisis, we actually raised this. This was very much on the hot topic anyway, as hotels were ramping up, really trying to decide at which point their numbers stabilize and at which point they become get to break even during the pre-opening process. It's a similar exercise for seasonal hotels, for hotels that have just been renovated. And of course, as the crisis hit, it became quite timely to start considering what that looks like. So we used our regression analysis, looking back through years of data, and actually populated what was now our break-even analysis for multi-segments. And actually what you can see is the luxury hotels generally broke even earlier than the other asset classes. And I think it raised some eyebrows, because I think the idea really of luxury hotels having such a large cost base really driving to a break-even point quicker than the other asset classes was quite a surprise. The difference really is that when you consider the fact that luxury hotels do have a higher cost base, they do also drive a premium in the bedrooms, but also the fact is that they're very reliant on ancillary revenues and F&B revenues that are also driving a premium. And without those in the current environment, it's very much a different assessment. What I can tell you in the current environment is that the last 3 months, luxury hotels have broke even at 32% across the board. And I think that really is almost in line with where we were with the break-even analysis prior to the crisis, and very much driven by the fact that although you've lost the ancillary revenues and very much other parts of the business, we've also driven costs down to a whole new level. And again, that will change over time, and we need to consider that. So in summary, we have seen costs increase and then normalize to prior year levels. We have seen huge drops in payroll, and those costs are starting to creep back up, although nowhere near the prior crisis levels right now. We have to consider that there are huge changes to the revenue mix and the makeup of hotels because of the new restrictions. And for that reason, measuring in TrevPAR, looking at the hotel in its entirety, and then looking at the journey from TrevPAR down to GoPAR is very much an important part of the story. So we're really looking at the context of how the market is performing versus your own asset is right now going to be very important to understanding when is the right time to open various parts of the building, and what will it mean to your P&L and to your owners at the end of it. And if I can leave you with one thing, it's right now, like I said, context is important, market insight. Right now, things are changing on a monthly basis. We're really trying to measure trends as we come out the other side of this crisis, but they are evolving as we move. So monthly insight, monthly understanding of how the makeup of your hotel performance is in context to the competitors is more vital than ever. Thank you very much. It's been a pleasure presenting to you. If you have any questions at all, please get in touch. Thank you very much.